All right, well, as we wrap up this shortened trading week, the markets are gearing up for Friday's March labor report. Now, economists say 247,000 jobs will have been added to the economy during the month. But let's check in right now with Dan Suzuki, Senior Investment Strategist at Bank of America Merrill Lynch. And Dan, how are you feeling heading into Friday's jobs report from a market's point of view?
I'm actually feeling pretty good about this Friday's report. If you look at the sell-off we had yesterday on the weak economic news, which put downside risks to the payroll report, I think we're set up for a positive surprise. Either way, though, I think the general trend for the labor market is that it's going to continue to be improving, and I think we're more focused on that than any individual job report where the standard error is basically 100,000 payroll, 100,000 jobs every month.
All right, now, of course, the Fed will be watching the employment data pretty closely as it preps for its first rate hike since 2006. But when do you think the central bank will raise rates?
As a house, we think that the highest probability timing for the first Fed hike is going to be in September, but it's really hard to tell. There's something like a 20% chance that they hike in June, a higher percentage chance that they hike in September, and then there's still a decent probability that they're going to hike in December. So it's really going to be, as the Fed says, data dependent.
All right, now what sectors should investors be eyeing, especially amid rising rates and the strengthening dollar?
Yeah, our view is that if they are going to be raising rates, but the global growth picture is going to be improving, then technology and industrials looks the most attractive to us. A lot of people are worried about the impact of the strengthening dollar on those sectors because they have a high percentage of their revenues coming from overseas, but we found that those sectors can actually still do really well if global growth is indeed improving, which is something we expect over the next couple of years.
So on that point, should investors be flocking towards some of those smaller cap names that maybe have less global exposure?
No, we don't think so. I think that's been a knee-jerk reaction that you've seen in the markets over the last 6 months or so. But I think that that's a little bit misinformed. If you look historically, there really hasn't been a consistent pattern with the way small caps behave with respect to the dollar. We actually think that because volatility is probably going to be higher this year, we think that you're going to see investors flock toward higher quality stocks, which is a great hedge against volatility. And the investors are going to seek out those companies that have the ability to consistently grow their earnings and dividends.
Even though the Russell 2000, which tracks small cap stocks, has returned about 3% so far this year compared to the S&P 500, which is largely flat?
Yeah, absolutely. I think if you look at the relative valuations of the sector, they're still extremely high relative to the S&P. And then also relative to their own history. So I think the risk reward is much better in large cap stocks. You've seen a huge flow into the small cap stocks and riskier stocks in general. And what no one's really talking about is the unsexy stocks, what we call the big, old, and ugly stocks. And we think that those underappreciated stocks are actually the opportunity. If you just look at last year's performance as an example, if you would simply put on one trade, which is to short the 10 most overowned stocks and to buy the 10 least owned stocks, your alpha on that trade alone would have been over 30 percentage points last year, and we've seen that that's continued to generate alpha so far this year as well.
All right, when you say unsexy stocks, what kind of names are we talking about here?
We're talking about those big, old, and ugly stocks. So if you look at the mega cap space, they have some of the best balance sheets and the best relative valuations relative to the market. A lot of people are worried about valuations, with a lot of the metrics that people look at, whether it's P ratios, price to sales and whatnot, trading above the historical averages. We're less concerned, but the real opportunity for buying cheap stocks is within the mega cap, high quality stocks, which are very unloved today.
All right, Dan Suzuki, Senior Investment Strategist at Bank of America Merrill Lynch. Thanks for your time.
Thank you.
I'm Scott Gamm, and you're watching The Street.